Ready to begin when you are.
Thank you, Ashley. Good morning. This meeting of the board is a hybrid physical virtual meeting. I'd like to welcome those in the boardroom with me today. While keeping your microphone muted, please join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. I want to take a minute before we actually get into the agenda to recognize an individual who's retiring after 40 years of public service, entire career being here at FCA. Robert Coleman began his career as an examiner in 1986. He has served in leadership roles in the Office of Policy and Analysis, the old ORP, our Office of Secondary Market Oversight, Office Examination, and the Chief Operating Officer. I want to wish him well in retirement at the end of this month. Robert, congratulations and thank you.
Thank you very much.
At this time, I'll ask the Secretary to the Board to address a few technical and protocol items.
We have a quorum. The full board is present for this meeting, Chairman Hall and Board Member Smith. Please ensure that you have silenced any mobile devices you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have two OIT staff, Ben Rana and Victor Amaya, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, "Next slide." If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Hall, that concludes the technical and protocol items. We're ready to continue when you are.
I ask the Secretary to read an opening statement on the Government in the Sunshine Act.
This is an open Farm Credit Administration board meeting under the Government in the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government in the Sunshine Act, Chairman Hall will entertain a motion to close the meeting.
We will now review the published meeting agenda. Is there a motion to adopt the agenda as published?
There is. Mr. Chairman, I move to adopt the agenda as published.
And I second the motion. The motion has been made and seconded. Any further discussion? If not, the Secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Next, we will consider whether any portions of the meeting should be closed to the public.
The agenda does not include items that we should properly discuss in closed session. I move that the entire meeting remain open.
I second the motion. The motion's been made and seconded. Any further discussion? If not, the Secretary will record the vote on this motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carried. Please turn to tab 1, and this next item on the agenda is approval of the minutes as presented behind tab 1.
I move to approve the minutes for the May 14th, 2026 regular board meeting as presented.
Second the motion. The motion's been made and seconded. Any further discussion? If not, the Secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Next, we will have a presentation on the quarterly report of economic conditions and the Farm Credit System condition and performance, and I'll ask Greg Lyons and Curtis Allman to present the quarterly report. This is an information item.
Chairman Hall, Board Member Smith, my name is Greg Lyons, here with my colleague Curtis Allman to give this quarter's report on economic conditions and the Farm Credit System condition and performance. In today's topics for open session, first I'll be going through the economic conditions affecting the Farm Credit System, through a look at the general economy, the farm economy, as well as an update on land values, before passing it off to Curtis to talk through the condition and performance. Next slide. So turning to the general economy, to start the year, growth in the first quarter of the year was a modest 1.6%, but the underlying health of the economy may be better than that first appears. First, economic projections at the onset of the year were continuing to show increased growth expectations for 2026. We also saw that things that accounted for the underlying domestic health of the economy, like real private final sales, were more robust at 2.4%. And forecasts for Q2 that do account for the latest data that's coming out do remain positive. An important piece of this continued expansion is AI investment. By one Federal Reserve Board estimate, about a 0.5 percentage point of growth in the third quarter of last year came exclusively from these AI investments. And it's likely that we've seen continued expansion of those investments since then. Now, what this does mean is that this is a highly concentrated form of investment, And without it, we're likely flat to mildly positive without it. Now, since the onset of the crisis in the Middle East, what we are seeing is downside risk rising. In the May survey of professional forecasters, expectations were for a lower and slower growth in the second half of the year, with a quarter of respondents assuming that growth in the third quarter may turn negative. And looking at some indications of leading indicators, there is concerns about a fragile economy with, again, this heavily concentrated investment in AI and personal consumption being the primary drivers of growth. Next slide. Turning to personal consumption, the good news is that through the first quarter of the year, personal consumption growth was positive, and early indicators are that that growth will continue into the second quarter, due in part to things like higher than average tax returns. But what we have seen is a consumer who is shifting their spending behavior. For example, in the last several months, we've seen a large amount of expended additional expenses on energy, and we've seen consumers turn away from spending on food service and drinking places. That spending has effectively been flat since the end of last year. We are seeing consumers who may be reaching their spending limits. Real disposable income has fallen, personal savings rates are at lows since 2022, and credit card and auto delinquency rates are at or near highs last seen during the great financial crisis. Now, what we may be seeing is a small subset of households driving consumption growth. About 50% of all spending comes from the top 10% of households by income. And in real terms, these households are continuing to drive spending growth. But what we have seen is for most households are really only increasing their spending roughly in line with inflation. Now, part of the reason for this growth may be additional assets, gains from assets that is helping boost the spending here. But what we will be looking for in the next several quarters is whether or not we can see a broadening of this economic expansion beyond these two pillars of AI spending and these high-income households. Next slide. Turning to inflation, US CPI was posted at 4.2% yesterday, with core CPI up 2.9%. More than half of this increase was due to increases in energy. We do see some indications in the producer price index that energy costs are having a large increase on inflation expectations there as well. So far, Federal Reserve forecasts do anticipate that this will be a largely temporary spike with headline inflation peaking in the second quarter of this year before going back down to roughly in line with Q1 expectations. Now, core inflation drivers, what we have seen is modest increases in shelter inflation driven predominantly by rental costs. But we've also seen that core energy, that core CPI has risen to 2.9% from 2.5% in February of this year. It is worth noting that core inflation does include segments that are very tied to energy. And so as we see energy costs decline through the back half of the year, that may also drag down some of these core inflation measures. Now, one update on tariffs. We have had some additional information here that suggests that a near full pass-through of tariff costs onto consumers. However, the estimates from the Federal Reserve Board indicate that the impact on things like PCE inflation were about 0.8%. And this is below what many economists had expected. One of the primary reasons for this is that actual rates that were experienced were far less than the statutory rates. But what this does mean is that the overall impact of those tariffs was less than many had expected. Next slide. Turning to the energy markets, what we have seen is that while prices have risen over the last several months, they have been mitigated by several factors. First, we've seen expanded production and exports in the US. We've seen a decline in East Asian demand, including a reduction in Chinese imports. And we have gotten some evidence of at least a trickle of oil coming out of the Strait of Hormuz over the last month. However, one of the primary reasons that prices have held is due to the drawdown in global stocks. Now, the IEA has indicated the current stock drawdown is the largest in history, and that stock depletion likely did accelerate into May, which helped really dampen these price shocks. Now, the real question is whether or not these stock drawdowns can continue and for how long. Oil infrastructure does have operational minimums, and various industry estimates place the point at which those operational minimums become binding through June of this year and to much later in the summer. Now, even if the conflict were to resolve today, there likely will be some tail to price normalization. Restarting refineries in the Gulf and production there will take some time. Shipping insurance costs are likely to remain elevated during demining operations in the Strait, and it's likely that many of these stocks that have been drawn down will need to be replenished, which will put some upward pressure on prices. For these reasons, this is why we see entities like the U.S. Energy Information Administration forecast that prices will remain elevated through the end of the year. Next slide. Now, turning to labor, labor entered into 2026 on a relatively soft footing, but what we've seen even within the last month is the beginning of a stabilization in the labor economy. What we have seen in last week is an increase in the number of job openings, that for the third month in a row, we got a good payroll number of 172,000 jobs. And while that figure is below some of the growth that we saw back in 2023, that number is fairly good for where we are now. And the reason for that is because in 2026, U.S. Population growth is forecast to be at its lowest point in about 75 years. And because of that, the number of jobs the economy needs to add in order for the unemployment rate to stay steady has fallen. Now, despite this, there still is some evidence of a low churn environment, even in the latest data that we're getting. Quit rates and hire rates are still at 10-year lows. There are very low premiums for job switching. The long-term unemployed numbers still remain elevated. If individuals have jobs right now, they are very unwilling to give them up. And there was, in the first quarter of this year, evidence of declining job quality with increases in marginally attached unemployment, increases in the number of multiple job holders, and payroll growth composition changes, where we've seen large declines in jobs in information, financial services, and professional and business services, and almost all of the job growth we're seeing coming exclusively from healthcare and social services. Now, the good news here is, again, even within the last week, we started to see a broadening out from that. We're starting to see increases in some of those higher paying jobs and a job growth coming from a wider array of segments over the last several months. Next slide. So that means that where we are is we're in a situation of rising headline inflation and increasing labor force stability. And what this really means is it has significantly changed expectations for the federal funds rate path. Now, in communications, the Federal Reserve has stressed patience. Former Chairman Powell had noted that core inflation expectations were still grounded when he spoke several months ago on the topic, and that employment was cooler but stable, and there was no need to respond to an oil shock with rate hikes. We've also seen changing use of the balance sheet, where a halt in quantitative tightening at the end of the year 2025 has put some additional pressure on long-dated treasuries. Now, there are some warning signs of changes in monetary policy. For example, at the April FOMC meeting, we had the most rate decision dissent since 1992, specifically around the inclusion of easing bias language. Now, the FOMC will reconvene next week and will be paying close attention to their communications to see if they do move away from that easing bias language. Next slide. Turning to the agricultural economy, the USDA forecasts that 2026 net farm income will be at $153.4 billion, modestly below 2025 levels, but still above historic norms. And the story here is largely the same as it was last year. High production expenses and relatively robust government support, with the caveat that we've seen a reduction in cash receipts on the livestock side and even more government support this year. In the crop sector, the USDA projects that most major crop producers will see increases off of the 2025 lows in income that they received last year, due in part to marketing opportunities as well as to program changes such as to PLC, which are paying out to producers in this year. For livestock markets, what we are seeing is continued strength in the cattle and calf markets, driven by 75-year lows in inventories and a reduction in processing and marketing that has led to some compression on feeder prices. What we also have seen is increased production for dairy, for hogs, for egg placements, all of that leading to increased production that is helping to moderate prices. Now, we are tracking the development related to New World screwworm. So far, the impacts are highly local, with limited expected impacts on production. But what we are seeing is whether or not it's going to have any impacts on U.S. exports. So far, we have seen a Canadian ban on imports of Texas cattle and also a Mexico ban on live animals coming from the U.S. But this is a rapidly developing situation that we will continue to monitor over the next month. Next slide. So after several years of lower prices, we have seen farm liquidity being impacted by those lower prices. Notably, liquidity is forecast to tighten in 2026. The USDA forecasts that sector working capital will fall by 9% in 2026. And survey data out of the Western states and Plain states indicates that loan extensions are rising, repayments are falling, and there's increased operating line demand. Now, there's two key differences from the last downturn in 2016 to 2019. The first is that the elevated interest rate environment does create some complications for producers' ability to recapitalize. But the other difference is that we have much stronger government support today than we did during the onset of the downturn in 2016 and 2017. Now, there are likely to be strain for producers that have either limited liquidity or who had very strained profitability over the last several years with lease-based operation, beginning operations, or producers who are in, for example, rice or cotton, or tree nut producers having more strain. Next slide. Turning to commodity prices, what we have seen in corn markets is that since energy prices rose in March of this year, that higher ethanol and biofuel profitability has put some pressure upward on prices. And similarly for soybeans, crush margins have risen as those energy costs have risen. Strong domestic crush, again, is still producing some upward pressure on soybean prices. For wheat, the story is a lot more about global supply and demand here, with drought and lower stocks than other commodities and production expectations helping to continue to boost prices. The livestock story, again, is more mixed. Going back to 2021, what we have seen is that cattle prices have just continued to rise based off those long inventories, while things like hogs and milk are trading more sideways as we see that production being able to expand into those higher price environments. But I do want to call out the gray dashed line there in eggs, where what we're really seeing is the boom-bust cycle of HPAI, where a destruction in supply led to high prices that then producers supplied into, which led to a rapid drawdown in prices. We're observing that for the second cycle today, which is why we've seen a rapid decline in egg prices within the last several months. Next slide. Turning to farm expenses, we've begun to see farm expenses climb after cooling through most of 2025. Notably, we've seen increases for feed, for fertilizer. We've even seen in the used machinery equipment, prices have begun to tick up based off some strong auctions after a while of plateauing. We don't have great data on labor costs here, but we are watching to see if some of those labor access concerns have put upward pressure on labor prices as well. But the key question for producers is how long is our fertilizer prices going to remain elevated? Next slide. Now, fertilizer cost spikes have had an impact this season, though those impacts are going to be varied. The first thing to note is that there will be differences on price shocks based off of type, where nitrogen fertilizers like urea that are physically transported across the Strait of Hormuz have seen the most increases in prices, where anhydrous ammonia and liquid nitrogen, which are highly exposed to energy costs, have seen increases as well, though not as extreme as urea. Now, non-nitrogen fertilizers that we either supply domestically or we import from Canada have seen negligible increases through the first portion of the year. And what this really means is that we're going to see impacts across regions and commodities. Both rice and wheat producers were liquidity strained coming into the season, but winter wheat producers are going to miss these fertilizer cost increases, while rice producers have needed a lot of urea specifically over the last several months. If you were a producer in corn versus soybeans this year, if you were a soybean producer without nitrogen needs, you would have no increase in your costs, while corn producers would bear more of those costs from the increases in nitrogen-based fertilizers. Now, there are several potential mitigants here. First, pre-purchases of fertilizer were slow due to high prices coming into this year, but a majority of producers still did pre-purchase fertilizer going into 2026. And while costs of fertilizer have risen, this has coincided with an increase in commodity prices, which has led to marketing opportunities that could help offset some of those increases. That said, liquidity-constrained producers coming into this year who needed access to nitrogen-based fertilizer in the second quarter may have been impacted significantly by these shocks. Next slide. Turning to farmland markets, we have continued evidence of land values stabilizing in the first half of 2026. What we have seen is that factors other than cash receipts are likely helping to stabilize those prices, with limited supply and steady demand, marginal easing in loan rates, and robust government support, all helping place floors on prices. We still do see some ranchland cropland divergence, where strong returns in the cattle markets are continuing to help put upward pressure on pastureland and ranchland. And out west, we do see is that irrigated cropland continues to gain over dryland. Now, the fundamentals still show some challenge for cropland going forward, with cash rent softening after several years of weaker cash receipts, the rate environment still being less supportive than it had been in prior years, and expected return growth in those cash rental rates relatively modest. That said, we're going to continue to monitor if this stabilization occurs through the next quarter. Next slide. Turning to drought conditions are persistent across much of the U.S., and the NOAA forecasts that those conditions will expand both into the northern plains as well as slightly west from where they are today. Winter wheat ended with 2/3 of all winter wheat in moderate drought conditions. Within the livestock sector, declining pastureland conditions have been coincided with 50% of alfalfa and hay being at least in moderate drought. Now, corn and beans to date have been relatively not impacted with low prevent plants and good soil moisture. The real change throughout the back half of this year is the currently developing El Nino pattern. Now, El Nino does not produce consistent weather impacts within the United States, but the speed and intensity that this El Nino pattern is developing has tended to coincide with warmer weather in the northwest and southeast, as well as wetter conditions predominantly throughout the middle part of the country. However, that is subject to change, and we will continue to monitor as that pattern develops. Next slide. Turning to global conditions are generally strong with excellent crop quality conditions in South America and pockets of drought in Eastern Europe. We are expecting there to be a record number of soybeans produced this year, although we'll get an updated WASDE number later today. The El Nino pattern that we mentioned on the previous slide is also going to have impacts for global production. What we tend to see here is that El Nino produces drier, hotter weather down in Australia and produces hotter weather down in South America, which can have consequences for future production. Now, we are keeping an eye out for potential non-weather supply disruptions here as well. Places like Brazil import the vast majority of their fertilizer and are highly reliant on urea, which has seen significant price shocks since the beginning of this year. And there have been some farm financing frictions down in Brazil, which means that even producers may not be able to get all of the inputs they need if they're not able to access the appropriate capital. Next slide. Finally, turning to agricultural exports, U.S. agricultural exports significantly reallocated in 2025. First, what I'd point out is in China, what we saw last year was a $16 billion reduction in exports. And we couldn't make that up with any one country, but what the U.S. was able to find was a coalition of other partners to help offset that significant decline from a major trading partner. For example, for soybeans, after China stopped buying U.S. soybeans, we saw Egypt, the EU, Mexico, Japan, and Indonesia all pick up their soybean purchases. It didn't completely offset the decline, but it did help significantly. For corn, we saw that Mexico has continued to be a strong export destination for U.S. corn. Japan, Colombia, and Korea also increasing their exports. And for beef, declines in Chinese demand for beef was helped partially offset by Mexico and South America. And what we're looking for in 2026 is, regardless of whether or not China becomes a major export destination for U.S. products, does this broad coalition of partners help to keep U.S. trade balances roughly in the state they were before the onset of trade conflicts last year? This coincides the economic portion of this presentation. At this time, I'll take any questions you have.
Thank you, Greg. Questions for Greg, Board Member Smith?
Yeah, thanks for your presentation, Greg. I'm really appreciative of the last slide on the exports reallocated. You know, a lot of focus has been on losing trade with China. I don't think many people can anticipate relations exactly getting warm and friendly in the near future, which affects our trade with that country. But the good alternative is to establish relationships with other countries, which has happened. No more evident than the corn market. Pretty amazing, the huge crop that we raised last year and the huge world supplies, and yet those corn exports to those destinations have helped maintain a base under corn prices. So it is being successful, at least in that market. E15 year-round passed the House. Their version now is being debated in the Senate. Any predictions? Obviously, that would help with our ethanol grind, would help with these big corn crops we're raising every year. Seem to get bigger and bigger every year. And I don't think this year is going to be any exception, given the early planting dates and the conditions we're seeing in the ice states like Jeff and I's home states. What do you hear, and what do you see on the E15 debate in the Senate?
Well, what I can speak to is that we have seen that the amount of ethanol out there, we are seeing very low supplies right now, and raising the blend limit is likely to help continue to put more throughput into there, especially in the current wake of relatively high energy costs and the high profitability that some of those ethanol factories are anticipating. That would help to boost those corn prices.
Yesterday, we talked a little bit about input costs and how they just don't impact domestic producers, and there's just a broader implication. Would you go a little bit more into that for us, please?
Well, again, we spoke a little bit about this in Brazil specifically, where if for the U.S. here, we are very well positioned to we have a lot of domestic production of a lot of important fertilizers, or we can access it from our neighbors. We have a strong domestic energy production market. That is not going to be the case in many places around the world. If you have constrained liquidity, as you do in many major growing regions, it will be far more difficult to access fertilizer, even in the wake of higher prices. And so the U.S. markets will be less affected, but you might see even in places like Brazil, which we consider to be large, sophisticated exporters, that it will be more difficult for them to access fertilizer under the current prices.
Greg, that's a good point. Thank you for the presentation. Curtis, I'll ask you to step forward, please.
Good morning, Chairman Hall, Board Member Smith. My name is Curtis Allman. I'm a supervisory examiner in the Office of Examination. For today's presentation, I will provide an update on the financial condition and performance for the Farm Credit System as of March 31, 2026. Overall, the system reported solid financial results for the first quarter of 2026. The system's portfolio continued to grow at a modest pace. Earnings growth was positive, which in turn supported ongoing capital growth. While credit risk measures trended higher, overall portfolio credit quality remained favorable. Next slide, please. We'll first focus on system growth. As of March 31, system assets totaled just over $584 billion, up 0.3% for the quarter and up 6.5% for the prior 12 months. System loans totaled $457 billion, up 0.5% for the quarter and up 6.1% over the prior 12 months. The chart on the left shows the percentage change in the system's portfolio loan growth by quarter. Loan growth in the first quarter of 2026 was modest, down slightly from the same quarter a year ago. The chart to the right illustrates system loan growth in the major loan categories for the past 3 years as of March 31 quarter end. Collectively, these loan categories represent 97% of the system portfolio. As the chart indicates, first quarter portfolio gains were primarily concentrated in agribusiness lending, mainly processing and marketing loans and loans to cooperatives. Next was rural infrastructure, followed by real estate mortgage lending, which showed modest growth. First quarter data for production and intermediate term lending showed declines in production volume. Production and intermediate term lending is more seasonal than other categories, with volume typically declining in the first quarter. Next slide, please. This next slide focuses on system loan quality. Overall, the system's portfolio continued to perform well in the first quarter, despite increased portfolio risk. The chart on the left shows non-performing assets. As of March 2026, non-performing assets totaled almost $5 billion, up from $4.1 billion at March 2025. Non-performing assets as a percentage of loans outstanding and other property owned increased to 1.09%, up from 0.96% a year ago. The increase in non-accruals was primarily related to credit quality deterioration, impacting a limited number of borrowers in certain stress industries, including poultry and eggs, tree fruits, nuts, and grapes. The chart on the right shows non-accrual loans by type as a percentage of loans outstanding. Non-accruals increased in all categories over the last year, with the exception of agribusiness, which declined slightly since 2025. Non-accrual loans for the total loan portfolio were 0.99% of the loans outstanding. The increase in non-accrual volume was primarily due to persistent low to negative margins in several crop sectors, reducing producer cash flow in 2025 and into 2026. Next slide, please. This chart focuses on loans classified less than acceptable by major loan category over the past 3 years at March 31. At the total portfolio level, less than acceptable loans increased to 6.6% compared to 5.7% a year ago. As the chart indicates, the percentage of less than acceptable loans was up for all loan categories in 2026 compared to 2025. Agribusiness loans had the highest level of less than acceptable loans at 11.1%. A limited number of borrowers in specific sectors faced unique challenges, including volatile demand, price weakness, difficulty balancing supply with demand, and elevated non-feed input costs. Loan delinquencies as a percentage of accruing loans declined slightly from March 31, 2025 to March 31, 2026. Next slide, please. Earnings. Overall, the system reported positive financial results for the first quarter of 2026. As the chart to the left shows, system combined net income totaled $2.1 billion, up 8.4%, or $165 million from a year ago. Provision for credit losses, which is the red line on the chart, totaled $233 million, down slightly from $250 million in 2025. The two charts on the right focus on the main components impacting net income, including the rate on average earning assets and interest spreads. For 2026, as the result of the continued growth in the system's loan portfolio, total average earning assets increased 6.6%, or $34.8 billion, and was the primary driver of the increase in net interest income. The chart on the bottom right of the slide focuses on net interest spread and net interest margin. Net interest spread and net interest margin were relatively unchanged in the first quarter. Any marginal change in net interest spread was primarily due to lower debt funding costs in the lower interest rate environment. Net interest margin was partially offset by a 2 basis point decrease in income earned on earning assets funded by non-interest bearing sources, principally capital. Next slide, please. This slide focuses on capital. First, the chart on the left shows total capital. In the first quarter, the system continued to maintain sound capital levels with strong earnings continuing to support capital growth. As of March 31, system capital totaled $86.4 billion, up $5.9 billion, or 6.8% year over year. The system's capital to assets ratio increased just slightly to 14.8% at quarter end, up from 14.7% a year ago. The chart on the right shows the capital benchmark ratings as a percentage of system institutions. Institutions with a total regulatory capital ratio in the benchmark 2 range increased 9% over the first quarter of 2025, as asset growth outpaced capital growth at those institutions. Tier 1 capital ratios remained relatively unchanged. The decline in asset quality showed on the previous slides is the driving increase in institutions with ratios in the benchmark 2 range for the risk-based capital measures as criticized and adverse volume increased. Regulatory capital levels at all system banks and associations continue to be well above regulatory minimums. System capital quality is sound, with retained earnings accounting for almost 77% of total capital. This is the capital component over which an institution has the greatest control and most readily available for asset growth, capital distributions, or to absorb losses. Next slide, please. FERS ratings. For an individual institution, the composite FERS ratings represent an overall assessment of the safety and soundness of that institution. The chart on this slide provides a snapshot of the combined composite FERS ratings for all Farm Credit System banks and associations. Overall, composite FERS ratings for the first quarter continued to reflect the system's strong financial position. Collectively, over 95% of banks and associations currently have a composite rating of 1 or 2. 3 institutions had a composite rating of 3 or worse, compared to 2 institutions at the end of 2025. Next slide, please. Risks we are monitoring. Agricultural producers and system institutions continue to face a difficult operating environment in 2025 and into 2026. Grain producers continue to face considerable margin compression as high production levels, elevated production costs, and export uncertainties have pushed prices lower, though we have seen some price recoveries recently. Agribusiness profit margins declined due to higher input costs and unstable demand. As we have already seen, this more challenging environment for borrowers is reflected in challenges to system credit quality. Changing economic conditions and an uncertain growth outlook for both the U.S. and world economies presented substantial challenges for agriculture. That said, the system is financially sound and has considerable risk-bearing capacity. Farm credit institutions are well positioned to meet borrower funding and liquidity needs. This concludes my part of today's presentation. Chairman Hall, Board Member Smith, thank you for your time and attention. Be happy to answer any questions you may have.
Thank you, Curtis. Questions for Curtis, Board Member Smith?
Yeah, one question of concern. I see, looking at the charts, Curtis, the last 3-year loan growth by far was led by the ag business sector. It did back off a little bit slightly last year, but still very robust growth in that area. And yet that sector leads in less than acceptable loan trends, and it doesn't seem to be improving. That's concerning when you consider the difficulty of collateralizing business loans. Any one sector that you can identify that needs to warrant close scrutiny, or area of the country? I don't know, like 10 years ago, we had a rapid expansion of the ethanol oversupply in the ethanol industry, and leading to distress in that. But any one sector that you identify, or a couple sectors we need to be watching?
Well, thank you for the question. In my experience, it's been difficult for different sectors to identify. I think there's concerns across purchase participations and different shared assets, those different types of things. We try to focus on working with institutions on making sure that they understand what they're getting into, and really focus on the due diligence process and those different elements. I've seen challenges in many different types of those loans that we've looked at. I'd hesitate to speak to any one area, but we really focus on communication in between the lead lenders and the institutions themselves. Is there a communication flow between the lead lenders and the participants, and that communication? And we have, regulatory criteria and guidance on what needs to happen when an institution makes a move, say, for either credit or collateral, those different elements, and to make sure that there is a consistent flow, because sometimes when there's a breakdown in that's a credit administration issue, if you will, not necessarily at the credit, but that's something that the system can tighten up. But yeah, there's issues across the board. when it comes to those. So we look at each individual one, and we have identified larger assets that we want to pull into loan samples. The credit specialist team in the Office of Examination, they focus heavily on certain specific ones that they want to see pulled into loan samples and have examiner eyes on those. So we have identified certain ones that we want to take a look at.
Kind of going back to Greg's presentation and then your slides on non-performing assets and then going to your capital slide, just emphasize the importance of maintaining high capital levels for the system right now, just given some of the challenge we're facing and those non-performing assets, just maintaining that high capital level, and hope we see that continue.
Absolutely. Appreciate that perspective. Thank you.
Appreciate your presentation. If there are no further questions, we're going to turn to tab 3. And at this time, I'll ask Angela Hansen and Gerard Gunner to present the semi-annual report on the Office of Examination Operations. This is an information item.
Good morning, Chairman Hall, Board Member Smith. I'm Angela Hansen, the Director of the Examination Guidance Division in OE, and I'm here with my colleague Gerard Gunner from the Office of the Chief Examiner. I'm from the Denver Field Office, and Gerard is from our Dallas Field Office. Next slide, please. Much of today's presentation is going to cover the semi-annual report of our Office of Examination Operations for the fiscal half, or the first half of the fiscal year of 26. We're going to be covering the risk supervision and examination activities of system institutions. We'll also cover some of the activities and objectives from our 2026 National Oversight Plan. We'll also cover activities related to examining the system's fulfillment of their public mission, and OE's operational efficiency and effectiveness and human capital planning, as well as some budget updates compared to our where we're at with the first half of the fiscal year. Next slide, please. So first, this slide highlights some of the accomplishments we've done in the first half of fiscal year 26 for our risk supervision and examination oversight. We conducted on-site examination activities as planned at all 4 of the system banks, 36 associations, and 2 other entities. We issued 20 reports of exam, 11 interim activity letters, and 35 FERS letters. And while most system institutions are operating under normal supervision levels, at March 31st, there were 2 institutions that had an elevated level of supervisory oversight. In addition to the oversight and exam activities, other examination-related efforts included issuing examination guidance, both to our internal staff as well as externally to the system. For example, we issued our 2026 National Oversight Plan for the fiscal year. We made 5 updates to our examination manual guidance, as well as reviewed our OE examination operation directives and made changes where needed. Some specific exam manual updates that we made included publishing our scoping guidance updates for our staff that coincided with our National Oversight Plan for 26. We also published updates to the Audit Committee work paper in December of 25. Published updates to our business continuity exam manual guidance to address the new cyber risk rule in January. And in March, more recently, we published updates to the business planning guidance to address the new business plan rule with the revisions regarding diversity and inclusion. OE staff also continue to participate in system work groups and external meetings. More specifically, we worked with the IDWG and the Small Association Work Group. Next slide, please. So in addition to the activities at the individual system institutions, there were also significant strategies and initiatives that we completed as part of our National Oversight Plan, or NOP, which focus on a broader set of system risk issues. Staff apply these NOP focus areas during their ongoing examination and oversight activities. NOP focus areas are usually nationally focused areas of emphasis, focusing on material and emerging risk issues that we see in the system. Listed on the slide are 4 of our NOP focus areas for fiscal year 26. We had 6 related strategies, which are on target to be completed in this first half, or target to be completed in the end of the fiscal year. Of the 6 strategies, 5 were systemic strategies and 1 was an institution strategy. Systemic strategies are generally reviewing and evaluating system-wide risks, while individual strategies are implemented by the EICs at the specific institution based on the risk level and the risk assessments we complete for every institution. So next, I'm going to highlight some of the key strategies and examinations for each of these different focus areas. The first was serving agricultural and volatile times. Credit specialist examiners developed specific risk assessments and scoping guidance for our exam staff, which we started implementing in December of 2025. on those examinations. They also updated guidance around loan review of distressed loans, as well as providing classification examples for reviewing credits under distress. They plan to develop an internal memorandum summarizing the results of the transaction testing that we're completing this year. About maybe November timeframe, they're going to have that wrapped up. The second focus area was operating resilience. Examination activities related to this risk topic include assessing institutions' reliance on AI and their use of AI in their risk management and different operational processes. IT specialists are evaluating AI use cases at a select number of institutions, also looking at their preparedness for different cyber risk events. 6 of the 11 planned IT examination activities were completed so far in the first half of this fiscal year. The third focus area was public mission and young beginning and small farmers and rancher programs. One of our consistent operating plan objectives year over year is to evaluate the system's fulfillment and serving the needs of agriculture in rural America. Our ongoing oversight and exam activities always include and address compliance with a variety of different mission-related areas. The last and fourth focus area was system loan data reporting. We didn't require any specific examination activities in this area. However, we do continue to prioritize and focus on implementation of the data change request that strengthen the structure and completeness of the loans to data. Next slide, please. So public mission, as I mentioned, we continue to focus on the importance of the YBS lending programs in the system. We evaluated compliance with YBS regulations as well as targeted transaction testing at a sample of institutions to see how they're implementing their programs. 2 examiners were selected to complete some YBS examination work at 10 institutions. 3 reviews are in process and 6 have been completed, and we're communicating those examination results in reports of exam and activity letters. The quantitative YBS rating strategies, including continuing to work with the system to improve the usability and consistency of our YBS lending and non-lending data. We're also collaborating with the newly formed YBS data work group amongst not just OE, but ODAE, Office of Information Technology, as well as Office of Regulatory Policy to work together to improve that data. Next slide, please. With regard to OE operational efficiency and effectiveness, we continue to enhance and to expand our examination tools, applications, and platforms that are available in our EDGE environment. Since October 1st, some of the key projects we've been working on include updating the loan work paper to improve our oversight and documentation of large and shared assets and participation reviews. We continue enhancing SharePoint and Power BI platforms across examiner programs. We've developed a project plan to modernize our training platform for our new examination staff. We continue developing merger-related benchmark and trend reports with OIT. And we began discussions with FCA labs, OIT, and ODAE on improving sampling tools and reports associated with loan data. We also continue to work closely with OIT to enhance collaboration efforts in the Teams environment and coordinating with ODAE on different data analytics and different tools that OE can use. And as I mentioned before, we continue to make progress on our loan database. We're working with the system to improve data quality as well as implement the data change requests that we issued to this last year. And lastly, we continue to work with ODAE and OIT to automate FCA's GIS processes. Next slide, please. And at this point, I'm going to turn it over to Gerard to provide a human capital and OE budget update.
Thank you, Angela. We are on target to complete strategies related to training, development, and knowledge transfer. For example, we continue to offer rotational assignments, advanced post-commission training, temporary assignments, and conduct training at OEL staff meetings and also field office staff meetings. As of March 31st, 2026, we hired 3 associate examiners who joined the class of 2025, 1 returning commission examiner, and 2 technical specialists. In the first half of the fiscal year, OE experienced 11 attritions. 5 were retirements, 5 were general attritions, and 1 was an interagency transfer. Our mid-year attrition level was 6%, an increase from the 4% we experienced at mid-year fiscal year 2025. We project we will not meet retention targets for fiscal year 2026. We were expecting lower attrition than average due to the DRP, but instead we are experiencing average attrition. Next slide, please. We have a long-term goal for total staff to be 190, with commissioned examiners representing 100 of those spots. We project we will remain below our optimal target for total examination staff and commissioned examiners as of fiscal year end 2026 due to the hiring restrictions experienced in 2025. With respect to OE staffing levels, the tables on this slide compare planned staff levels to projected levels at fiscal year end. With total OE staff, the chart on the left side of this slide, and commissioned examiners, the chart on the right side of this slide. For total OE staff, we began fiscal year 2026 with 178 staff on board, 2 less than planned. At fiscal year end, we anticipate we'll have 17 attritions, including 4 that occurred since March 31st, and 19 hires, including 10 that have occurred since March 31st, increasing to 180 staff on board, or 10 less than optimal, based on 190 long-term goal. The variance between planned and projected is a combination of fewer on board at the beginning of the fiscal year and more attritions and retirements, as I mentioned earlier. With respect to commissioned examiners, we are projecting to end the year 4 commissioned examiners lower than planned, due to less examiners sitting for the commissioning test than planned. For our commissioned staff, we experienced 5 attritions, which consist primarily of retirements. This will be offset by 8 newly commissioned examiners. However, we will still be below where we'd like to be both short and long term. Next slide, please. Next, I will cover the OE budget results. With respect to OE operating budget, as illustrated by the chart on the left, we used 48% of our budget as of March 31st. Actual expenses were less than our net budget. OE contributed $800,000 in available budget authority toward meeting the agency's fiscal year 2026 Q4 assessment reduction of $7.5 million. The table on the right shows we are projecting full-time equivalents to be slightly higher than budgeted due to increased hiring above what we initially budgeted for. We budgeted for less hiring due to hiring restrictions that were later lifted. Next slide, please. In summary, we continue to effectively conduct oversight and examination activities during the first half of the fiscal year. We are on track to complete our operating plan and objectives and strategies, including our National Oversight Plan strategies. We remain highly focused on ensuring OE has sufficient highly skilled staff to accomplish its mission. And finally, we remain within our budget and are within the budget parameters. Thank you for your attention today. Angela and I would be happy to answer any questions that you may have.
Thank you. Board Member Smith?
No questions, but I'll just say it's nice to see a lot of your staff in from the field offices this week. Number of interns, that's always good, looking ahead to fill those ranks. So great. It was fun visiting with some of those young people and what they saw in FCA and understanding the mission. So good amount of success for that. Thank you.
Thank you, Board Member Smith.
No questions, but just kind of want to comment too. We're working on the Future of OE project, which I think blends in very well with what you all have covered. I mean, part of it is adding staff, but part of it's adding staff in the right places. And we hope by the time we get that report in, probably in the next few months, that'll help us sort of plan for the future on how we address some of those challenges. So appreciate that. Appreciate you both coming in.
Thank you.
Thank you. No further questions by the board. Thank you. And we're going to now move to the adjournment tab. And if there's no further business to bring before the board, I will entertain a motion to adjourn the meeting.
Mr. Chairman, I move we adjourn the meeting.
Second the motion. The motion has been made and seconded. Any further discussion? If not, the secretary will record the vote on the motion.
Mr. Smith,
Aye.
Chairman Hall.
Aye. Motion carries and the meeting is adjourned.